what is coming. That's what at least one financial expert is saying. Charles Brown of CB3 Financial says,
one of the brilliant moves that Kmart has done is to partnership with Facebook in these e-gift certificates, so you can actually...
Of government mismanagement. Charles Brown is the president of CB3 Financial Group. He joins us this morning from Chicago.
Significantly dropping. Basically, this is the year of the consumer.
Believe that they're capable of managing anything?
Well, it's sort of like handing the keys to the chicken coop to two wolves.
Good evening, everyone, from Nashville. It is Thursday, January 14th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're glad you're with us. From COVID, U.S. politics, and the world economy to clarity. This is CB3 Live. For those of us that are new on the show here, we do this every Thursday night. Tonight's main topics, political pathos and awaiting earnings. If you're new on the program, you'll want to head over to our YouTube, which you're probably there if you're watching, although you could be watching us on Facebook. And be sure to subscribe so you know when we go live. Click the little bell and you'll get a notification whenever I go live. Almost every Thursday, sometimes Mondays, and occasionally other days when there is late breaking news. Also follow me on Twitter. And we're also on LinkedIn, and our LinkedIn audience for some reason is growing like 3 times faster than everybody else. I don't know why, but anyway, we're there. And of course, Facebook as well. So Corona America, where are we? You know, I keep hoping this topic is going to get diminished, but it's just not, and it's pretty big tonight. So cases yesterday, 250,000, almost 250,000 new cases. Now, as we've been saying when we started the program back in March, the reality is here that this could be that these are new cases of people with COVID. They're not dying from COVID necessarily, but they might be dying with COVID. So there could be some comorbidity involved there. But the U.S. death number, we're going to cross 400,000 by the time I see you next. It's grim. And almost every one of us, I certainly have people in my life I know, but I've lost 3, I think, so far. And it's tough. So guys, you just got to follow the protocols and stay safe. Around the world, we're going to cross 2 million deaths, again, by my next show. But we do have a little bit of good news, 32,500 roughly vaccinations, 32 million. Just a great number considering this is just a relatively new pandemic. Usually this takes years to get done. So whether you want to credit the current administration or modern science or both, that's good news. And amazingly, the MSCI World Index, Morgan Stanley Capital Industries, World Index of Stocks up 14%. As you guys know from following us, we were up much higher than that. But in general, we have to try to separate the financial impact from the human impact of this COVID-19, because that is our job and that's the nature of this program, is to cover the financial markets. We are seeing a reduction in COVID hospitalizations. Now, this peaked in early November, and it's been coming down since then, and it's actually heading back to where it was in early September. We're hoping this trend keeps going in this direction and dips below that zero line as far as the moving average. I'll keep you up to date on that, of course. So the vaccine, this is a big deal. There are a lot of people waiting, and I thought I was going to be like the third tier here at 65, but just this week, we've got 128 more million people waiting to be vaccinated because they've dropped the age. They want everyone now that's 65 and older, or anyone 16 to 64 with medical conditions. So that's a big line of people waiting for vaccinations. It'll be interesting to see if they can roll out that many. But it's good to see that. So Disneyland, this is the California location, is actually opening up a mass vaccination site. They're going to be handling 7,000 people a day in addition to still carrying on business operations. But this is great to see. You don't always see big corporations jumping in to help the common good, but I count this as a big plus. And hope to see more of this from other amusement parks, perhaps, where people, large numbers of people gather as the summer months approach. This map shows you the dark is good, so I'm happy that Tennessee here is in the dark. That means that more than 3.5% of the population, the shots have been given, the doses have been given. Some of these, like the Pfizer, needs 2 doses to, I think, a week and a half apart. But, we want to see more dark states here as this vaccination rolls out and more people take it, at least those that want to take it. 9 million Americans have received this vaccine shot, according to the CDC. Basically 225 million plus have been distributed, and just trying to get them all, as I said, the Disney situation is a great thing when you can get people in a place where they can line up to take it. Again, for those that want to, it's not going to be something that everybody wants to do. This is new data to me this week, but I'm just tracking inflation. So every time we start a new year, I want to see where inflation was in the previous year in 2020. And then look at it and see what's happening. Well, in the medical services industry, inflation just dropping, hospital services, medical care services dropping, prescription drugs dropping. Now, this is not necessarily pricing. This is inflation. So especially when you see it drop below the zero, that means that prescription drugs are actually going down. Now, this is something that was part of the Trump administration's initiatives. They wanted to be able to drop prescription drug rates, and they put pressure on Big Pharma to do that. There are some out there that say, and this is general knowledge, folks, that Pfizer held up announcing their vaccination until after the election as payback to Donald Trump. Now, I realize this is a financial show and not a political show, but you guys have been watching this long enough to know that the two are intertwined. And did that affect things? It's going to affect policy going forward into 2021, but regardless, seeing dropping prescription drug prices is a good thing. And then just across the healthcare component spectrum, physical commodities, physician services, hospitals, related services, health insurance. Look at this huge swing in health insurance, bumped up in January 20. And that's, of course, why the current administration, at least for the next few days, was pushing so hard to get this cost down. And they managed to do that. Okay, so I see this as making healthcare more affordable as we go forward. It'll be interesting to see if the next administration can continue this trend. So how has COVID affected the American worker? Well, you've got 10.7 million officially unemployed, 3.7 unemployed but classified as employed because they're just not in the labor force. 4.9 million dropped out of the labor force, and then the rest of them just a cut in pay and a cut in hours. This data, as it gets updated, will give us more of an idea of what the economic impact has been from COVID-19. Again, it will take years for all of this to fully be processed. So tonight's question in the COVID section, will you get the COVID-19 vaccine? Yes is answer A, because I choose to do so. B, yes, because I have to. We actually have a family member that had to get it because she was required to by her job. Answer C, well, I don't really know yet. Answer D, no, I just don't trust the vaccine. Or E, no, I'm just staying inside and I don't need the vaccine. So as you guys know, there's about a 25-second delay. Let me look in the chat box, see if we've got any questions here, and start typing your answers, and we'll talk about them. Hey, Mark Burns, how are you? Dr. J, how are you? Good to see you. Thanks. Improvement on the microphone there. So, hey, Deb from South Florida. Good to see you. Say hi to Steve and Tom. Do I think tech stocks will be a winner again in 2021? I absolutely do. We like tech. It is our number one sector because of the House and Senate changes along with Joe in office. I'm going to talk about that. Thanks for that question, Tom. Realistically, the markets just don't seem to care about what's happened. I'll get to this in my third segment, but I still like tech. We still like communication services. We still like the discretionary sector. There are 11 sectors. We're only significantly invested in 4 of them. Long answer, Tom, but there's your answer. Okay, what do we got here? A, I'll take them. Okay, Doc's going to have the vaccine. Hey, Andre from New York. I just don't trust it. I get it. Martha, yeah, it doesn't surprise me. Tom, you're going to take it. Charles, hey, from South Florida. Debbie, nope. Okay. And A, absolutely. K, hey, Greg, how are you? Good to see you. From Sugar Grove. All right, well, yeah, so I guess it depends on your situation, your mindset, and I may ask this, more than once here in 2021, because depending on the news and the rollouts, and if there are any after effects that are reported, this could change. But it could be, for instance, now if you're watching the news that you can't fly to America unless you can prove that you've had a test within 72 hours. So this is an evolving thing, and it will affect the investment markets, in my opinion. Let's look at the U.S. economy. So year to date, guys, these tiny numbers. I know you got used to seeing 30s and 40% because, we finished last year really strong. But the NASDAQ 1.7, S&P 1.1, Dow 1.3, no real leadership there, but the leadership is in the Russell. The leadership is in the Russell at 9%. I mean, that's kind of amazing. CG for the year up 4.1, so easily beating the S&P. But check this out. SG, okay, so SG came on strong last year and overtook CG in the last 3 weeks of the year and is just out of the gate on fire. For those of you that are clients, you know what CG and SG are because you probably have one of those accounts, if not more than one. For those of you that are not clients and have been watching, these are my actual account statements with the account number blocked out at Interactive Brokers. For those of you, again, new to the program, I think we have some new people on this week that said they're going to be watching. We trade at CB3 Financial 4 investment programs. All of our clients are in the same programs that I trade for our family trust and retirement accounts in different allocations depending on their risk tolerance. But everything I do, I have the same flesh in the game, as they say, that you guys do. Okay, so let's see, where do we go here? So the NASDAQ, not a surprise, still the leading performer of the major three indices. But look at here, the Russell versus the NASDAQ. Now, this won't surprise you because you saw the NASDAQ up 9, the Russell up 9 with the NASDAQ up just 1.7 for the year. Now, you see this basically breaking out in November, and I've had at least a couple people say to me, well, okay, so if this broke out, why haven't you just switched over to the Russell? I mean, as far as, more small cap stocks. Well, here's the reason right here. This is the Russell versus the NASDAQ, and it's straight down except for, I wish I could use the pointer here. You see the little bump up here at support? Basically, you have to go back 21 years actually, to where the NASDAQ basically was outperforming, or underperforming, I should say, the NASDAQ, and now that's bounced off. We have added IWM in SG, which is the 2000 ETF, Russell 2000 small cap ETF, and we are expecting to add more small cap stocks in February, because if this trend bounces off, look what happened back between 2000 and 2002. Really strong for the Russell, and we want to be part of that, okay? So I'm just looking at a comparison here on Seeking Alpha, just basically price change between these assets. And, we've been comparing how various stocks have done versus the S&P 500. Tesla, of course, has been one of my favorites. There's Bitcoin. Now, for those of you that were watching last week, okay, and I'm not going to talk much about Bitcoin tonight because I sort of had my hat handed to me. I started trading Bitcoin, for those of you that are new to the program, with 50 grand, and it was up to 176 last Thursday night. It traded to 181 on Friday night. Remember, Bitcoin trades 24/7, 365. On Sunday night, my account was worth 118, so it was like a 34% haircut. Okay, it's back in the 160 range right now. But guys, just too volatile for you to be trading. I'm still scoping it out. Again, as you guys know, I don't put anything out there for you guys to invest in unless I've invested in it for quite some time and I'm comfortable with the trajectory and the volatility in the asset, okay? So look at here, basically these are the big winners from last year. Tesla, Peloton, Etsy, Moderna, L Brands. Only one we missed on this list was L Brands, and frankly, I'm not sure how I did. I've traded it before. We just didn't hold it last year. But we're always looking to outperform our benchmark. The benchmark is the S&P 500, but candidly, I'm always paying most attention to the asset class that is outperforming the other main asset classes, the Dow, the S&P 500, the Russell 2000, okay, and the NASDAQ. And right now, as I said earlier, we're following the small cap. So when you see Tesla up there, you guys know I'm a big fan of Tesla. What is it about Tesla that I like? First of all, it's a consumer discretionary, and I really like the electric vehicle space. But Tesla is not the only game in this space, and we actually own the stock here, but we're going to talk about right now.
A little out of juice, only 42 kilometers range left, and that's why we need to come here.
When Jeff Shaw needs to get his car refueled,
师傅，你要来吗？
he doesn't go to a gas station, and not always one that charges electric vehicles. Instead, he goes to a battery swap station. In about 5 minutes, he can have his EV battery replaced with a fully charged one that has a driving range of up to 260 miles, more than enough for the 42-year-old's daily commute to work.
好了是吧？啊，好，谢谢啊。再见。And it's way faster than the gas station experience, I think. Let's go.
Shaw is driving a NIO, a rising star in China's electric vehicle market. Once on the brink of bankruptcy, the startup was bailed out by the government and has since seen its shares soar. At the end of 2020, NIO was worth more than General Motors, ranking as the world's 5th most valuable automaker. And that has a lot to do with its batteries.
就是车电分离，不光是技术上可以分离，产权上也应该能分离。
In other words, a NIO customer doesn't need to buy the vehicle with the battery, and so far, it's the only automaker in China to do this. Many investors say NIO's commercial strategy is revolutionary. So as Tesla speeds ahead as the market leader in China, should it be worried?
The gas station's on the big screen, and there's the battery pack getting swapped out.
NIO isn't the first electric vehicle company to try switching out the battery.
You have the choice of a battery pack swap, which is faster than you can fill a gas tank.
In 2013, Tesla demoed its battery swap technology, and the following year built a trial swap station in California.
Voila!
Tesla later dropped the project, saying drivers weren't interested in swapping their batteries because the supercharging stations were fast enough, even as these chargers can take more than 75 minutes to fully power a car.
We'll be expanding the supercharger network quite substantially over time.
Despite Tesla pulling the plug on battery swaps, its Chinese rival NIO is moving ahead with the technology.
The concept of battery swapping is fairly straightforward. The actually implementing it and making a viable business out of it is quite a bit more complicated.
Sam Abiel-Samed is a car analyst who has been watching the EV industry for more than a decade.
Batteries are the single most expensive component in an electric vehicle. But the problem is batteries are also still in a rapid stage of development. And so to date, manufacturers have been reluctant to standardize anything.
But NIO is choosing to standardize the battery. So while most electric vehicles have battery packs that are uniquely designed for specific models and are built into the cars, NIO has one battery pack that fits into all its models. And this battery costs about $10,700. So that means NIO's cheapest model, which costs around $52,000, gets a 20% discount if buyers choose to skip the battery. The company said a third of its customers are buying cars without the battery.
Tesla and NIO, they have taken some different approaches to the business model. I think battery swapping would certainly make NIO very competitive to Tesla and to other companies.
For a flat fee of about $150 a month, NIO drivers can get 6 battery replacements at more than 160 battery swap stations across China.
When you drive these gasoline vehicles, their service come to the end or when the dealer delivers the car to you. But for NIO, it's a very different experience.
NIO drivers also have other battery options like charging at home or using an app to request a charging truck to show up. But its services and stations in China fall far short of what's needed to convince the world's largest EV market to uptake battery swap vehicles. Just compare the number of NIO's battery swap stations to Tesla's supercharging stations in the country, and the more than 2,000 stations it has worldwide. And this is where the government comes into play.
Battery swap now is getting more attention, right? Looking into the policy support behind it.
Zhu Gong is an auto consultant based in Shanghai. He says in the long run, government policy will likely determine how the EV industry in China develops. Beijing already has a 2035 goal for broad EV adoption in the country.
继续大力推进这种充换电基础设施的建设，进一步完善相关技术标准和管理政策。
Battery swapping is getting a push this year. For the first time, the technology was mentioned in China's annual policy blueprint. There's also a subsidy that seems designed to help NIO. Consumers who purchase battery swap vehicles with a minimum driving range of 250 miles can receive about $3,500 in subsidies. However, electric vehicles without battery swaps can only qualify if priced below $46,000. Tesla had to cut the price of its Model 3 in China by 10% to meet that threshold. This type of support has persuaded other Chinese automakers to signal that they too could adopt the technology. But Xu says it'll take a critical mass of automakers to commit before China runs on battery swaps.
You can think of it could be like a mobile or the Chevron type. They build the swapping station. They provide a different type of batteries, big size, small size to fit into different vehicles.
Tesla Shanghai Gigafactory.
But Beijing isn't only supportive of NIO.
We want to very much say thank you and appreciation for the Shanghai government and the support.
About 1 year after Tesla started building its Gigafactory in Shanghai, it started delivering Model 3 sedans in China, far outpacing the sales of NIO vehicles.
We intend to continue making a significant investment and increasing the investment in China.
NIO is still playing catch-up, but Jeff Shaw's betting on the future of the Chinese startup. So much so that he bought shares of the company.
NIO is absolutely in the front line of state of art. It's more than a brand. It's more than a vehicle.
So I showed you this because I'm following this emerging trend towards electric vehicles, obviously, and how the various companies are handling these challenges. Obviously, if we had a battery that would last 1,000 miles, none of this would be an issue, but we don't yet. I think we will, probably even in my lifetime. I'm not sure, but if Elon Musk can figure it out, he will. I want to thank Leo, who's one of our viewers, who said the battery swap technology was originally invented by a better space company almost 20 years ago. So a lot of these technologies have been out there. It's almost like the secondary products that are needed for this industry may have even arrived earlier in the cars that they're being fitted for. Question from Mark about solid-state battery companies and that make them in England. I don't know that much about that. I will have that answer for you next week. But a few of the relatives got in NIO, $5 surprisingly, and strongly believed in it. Yeah, so we have been in NIO. Good, Andre. We've been in Tesla and NIO for quite some time. NIO's been as good a performer as Tesla. I like the electric space. There are other spaces we're looking at. I'll talk more about this next week. But 4Q earnings right now, obviously here the first month of the year, we're talking about the previous quarter in earnings. The prediction is going to be that the overall earnings are going to fall again in quarter four. I'm not sure I believe that. I think we're going to have some pretty good turnouts here, especially in the four aggressive sectors. And we'll see how that pans out. It starts tomorrow, so we'll have a lot of earnings. That's why I don't have the usual. You guys are used to seeing that Reuters chart here. That won't be there tonight because earnings haven't been announced yet. But tomorrow it starts with the banks. I'll get to that slide in just a second. So which industries, now these are industry groups now, not sectors, have the highest and lowest rates of employment growth? Okay, so that's a good thing. Green is good. Apparel manufacturing, who would have thought that? Well, that's because we still have online sales, even though foot traffic at malls is reduced. Couriers and messengers, of course. Petroleum coal products, because people are staying at home, okay? General merchandise stores and employment services, that's people looking for work. That would make a lot of sense, okay? And where are we down? We're down in food services, leisure and hospitality, scenes. I got a call come in. It's kind of distracting me here, guys. Sorry. Sightseeing, transportation, arts, entertainments, amusement, and gambling. I mean, these industries are getting hit hard. So, but what we're doing, obviously, to figure out what we're going to do this year is to see when the first earnings come out, and those are always in the financial sector. And so this could be kind of messy, and why the 10-year yield has such a huge influence on what bank stocks are doing. And the 10-year yield, which was below 1%, has now creeped up above 1%. I think it's about 116 today, 1.16%. I think it's on its way to 2%. We'll have some projections later on in the program, but I think it could be very good for the banks. We are seeing the World Bank Index pull ahead of the S&P here, but not really seeing much of this reflected in domestic banks. We'll be watching for that coming up. So where are the job demands? Where are we seeing job growth? Home health aides, fast food workers, restaurants and cooks, software developers, registered nurses, etc. All these areas, are strong. And I expect to see growth here. We'll be watching for these direct industries and for the support industries in these areas, and we'll be adding, stocks in that area. That's what we're doing for you. That's our goal, because we're trying to always outperform the S&P. Okay, so let's look back. We look at these particular charts, every month or so. Look at the 2008 Great Recession and recovery. Compared to 2020, we had a great initial recovery here in 2020, and it's kind of flatlined now. And we know why. The second wave, or as some are calling it, the third wave, has been a little stronger than we would all like to see. And I'm hoping that if it flatlines and then just continues the recovery trajectory of 2008, that would actually be a pretty good accomplishment. I don't think it's going to take 72 months to get back to where we were in February of 2020. I really don't. So I'm expecting to see this, and I'll continue to report on it, increase and get back to that zero line. I'm hoping within 36 months. So that's the goal. Is inflation an issue? Not by the metrics that we're using. We are seeing price increases or inflation, I should say, in appliances, cars and trucks, care, obviously domestic care. We're seeing that. We have a situation in our own family where we're trying to get care, and it just is so expensive. Household cleaning supplies, because we're home more. And then exactly the losers that you would expect, as I said earlier, prescription drugs going down. And that's because of pressure, in my opinion, from the current administration. Motor vehicle insurance. Why? Actually, I mentioned this, several months ago. We got a refund from our auto insurance company because it's a mutual company. And when the claims are down, they can refund part of our premium because they're just not needing it. Why are the claims down? People weren't driving. I still think they're not driving nearly what they were a year ago at this time, but it is getting back to a little bit more like normal. And then gasoline, airfares. The airline industry, I just don't know when this is going to get back to the way it was, although they're valiant and they're trying. The December CPI Consumer Price Index did clock in higher, but it's just not a concern. The key takeaway, look at the third paragraph, is that it's not going to trigger any alarm bells. Why? Because it's just up 1.4% year over year. The Federal Reserve's target is 2% year over year inflation. That's a healthy amount. We want to see some inflation because then we don't have to be concerned about deflation. Okay? All right. CPI and new vehicle sales. And again, this is year over year consumer price. And that's where we're seeing, a rise in costs. These aren't actual sales. This is the consumer price index for new vehicles. The underemployment rate continues to drop. So it spiked at 23%. Remember that U6 is underemployment. U3 is unemployment. Underemployment are those people that would like to work full-time, but or only have part-time availability or part-time work offered to them. Okay, we like to see this come down, keep going in that direction. CPI for food, as you would expect, carry out. I'm going to go on record here and probably embarrass myself. We moved into our new home here, and we didn't even pay attention to the prices. We just wanted some donuts on a Sunday morning. And I think by the time it was all done, it was $40. And that's because these delivery companies, plus the producers of the food, are realizing, they can pretty much charge anything they want. So we're getting more careful about that now. Rebound in apparel inflation. And I like seeing this. We have been in Lululemon and other retailers. That's really about all we're in right now. But I think that there's a ways to run on this. You can see the black line coming up here from a really dire early January of last year to where we are now. And I think there's room to run with apparels, especially in online sales. And I tell you what, if you're a company that's not fully embracing online sales, you're going to have a tough time. Interesting to me was that U.S. household net worth spiked last year, and that's mainly due to home prices and stocks. So those families that own stocks, that would be pretty much everyone on this line. And that's why, again, it's so important, guys, that what we're doing is managing your assets to keep you ahead of inflation and to the very best of our ability to keep you outperforming, I should say, the S&P 500, okay? So where are people quitting jobs? All right. Well, no surprise here. Food services, leisure, hospitality, retail, professional, and then it sort of flattens out. And construction, actually very little attrition there. Here in the Nashville area, we are seeing unbelievable amounts of construction. When I was back in Chicago, in the Loop area, we saw a lot of construction as well. Very little in Illinois that I saw outside of the Loop, but in general, construction is picked back up. The home builders are doing pretty well right now. I want to look back one last time here on 2020. By the way, yeah, I gave that a 1 star for the year. There were some high points, and one of them is a company called Instacart. Basically this whole groceries at home. Amazon's doing it. Walmart's doing it. I think pretty much anybody that's a huge entity is going to be delivering groceries because more people are eating at home. They just feel safer. Even with the vaccine, when it reaches the mass quantity of doses that it'll need to reach, I still think you're going to see people ordering groceries and having them brought to you rather than go to the store. I could be wrong, but that's what I'm expecting, and we're investing accordingly. Manufacturing PMI last year finished right at the 2017 level, okay? And I think it's going to continue to grow from there. We're encouraged by that. This industry, manufacturing, is looking beyond the pandemic. Existing home sales. Now remember, most of the time we want the charts to be higher. This is a chart that's not so bad when it's lower. Sales inventory. Well, it's actually, if you're trying to sell a home, it's pretty good because it means it's a seller's market when the inventory is this low. If you're trying to buy, it's pretty tough. But basically, this means there is demand in the highest dollar value discretionary income item in America, and that is homes. Okay, manufacturing jobs, 10-year high as the year finished last year. Love seeing this. The U.S., so much manufacturing was taken offshore. NAFTA, of course, affected that dramatically. Canada, the U.S., China, Korea. But we're seeing manufacturing come back, whether you want to attribute that to the current administration or not. This is the hard data, and it's good for America. And interest rates. So why are people able to get bigger homes, trade up, finance, refinance? I mean, we got a loan at 2 5/8 here in Nashville, but we're now seeing the norm, the median, at 2.5 for 30-year fix, which means a 15 is probably available at 2 3/8, maybe even 2 1/4. It's just a staggeringly low rate. It really is. And that's part of the 2020 story that I wanted to make sure that you realized. So for our second question, and then I'll check the questions here in the column, the U.S. stock market in 2021 will be more volatile than in 2020. B, it'll be less volatile than 2020. C, it'll be less volatile unless politics get ugly again. Or D, pretty much back to normal the way things were in 2019. I'll give you guys a little time to answer this, and let me check the column here. So, all right, and I'm with you, Dr. J, on the battery swap. I'm not going to wait for an hour. I'm not even sure I'd wait 15 minutes. I'm just too used to, well, I guess it takes 15 minutes to fill a car and go inside, but love the battery swap idea. I think Tesla will return to that. Mark Burns already responded to the solid state battery thing. I'll look that up and get back to you. Yeah, NEO. Yeah, I wish I'd caught Andrea. I wish I'd caught NEO at $5. I think we were in the 25 handle, but space exploration, not quite yet on that mark, although I hear it's going to be out of this world once it really takes off. So what do you think of stock market investment apps like Robinhood? So almost any reputable firm, this is from Tommy, has an app. I'm not a fan of Robinhood, but they're, TD Ameritrade, Fidelity, Vanguard, Interactive Brokers. There are just a ton of great companies that have great apps, and I do like them. I should know more about Robinhood, I suppose, but it's kind of a different investor than I am or my clients are. What do we have here? Less volatile, more volatile, says Charles. Okay, B, I hope. Martha, I'm with you. Probably C, yeah, unless politics get ugly. I think it's not. I think, and that's why when we get to the next section, I've got a little announcement there. But so Debbie, less volatile, good. Another Debbie Domagowski, it's C, yeah, less volatile. Greg, C, okay, B and C. Politics will get in the way. I don't know. It could be real quiet. There's a reason he's nicknamed Sleepy Joe. That's not a political derogatory remark. There's more than one person that calls him that. I mean, we've had a thundering bull in a china cabinet for 4 years, and now it's going to be a little quieter. So 20 to 21, guys, 20 to 21. Last week, I talked about the two biggest events or occurrences that could happen to really make things move. First is cryptocurrencies, and the second is the back to work mindset with Zoom and people working from home, et cetera, and those challenges. I want to look at a few more tonight. Okay, so economic expansion probably has years to run. I've been telling you guys we're in a secular bull market. If you look at the chart here, you're going to see the average bull market's about 5.3 years. Now, if we ended the bull market, which technically we did, we dropped 33% roughly all the way down from Feb 19 of last year to March 23rd. So we went from a lifetime highs to a bear market in 5 weeks. So it means we're starting over, from March 23rd of last year. And if we've got 5 years on top of that, guy, that kind of breaks in line with my thesis on it being a secular bull market for 10 years. I think the secular bull market started in 13 and never ended. I don't think it ended last year. I think that was just a blip. It was an ugly blip, but I'm with this chart. I think we've got another good 4 to 5 years. Will there be pullbacks? Yes. Will there be cyclical bear markets in there? Yes. Is this secular bull going to be intact? I absolutely believe it will. So other forecasts here. As far as your GDP, U.S. 2.2 is 2019, minus 4% is what they're expecting for 2020. We won't know until we get the third reading. We get the first reading on GDP for the year later on this month. And then in March, we get the final reading. But I'm looking at this inflation number. The inflation was down in 2020. It's going to be up just a little bit in 2021. If you remember from earlier tonight, I said that's a good thing. We need a little bit of inflation, or else you're going to buy your home and 20 years later you're going to sell it for the same price. So we have to have some inflation. We just don't want it to be rampant. Okay, rampant. So other areas, the market, this is kind of the average of what I was able to assemble here. I'm not going to worry about the earnings per share and the treasury yield, but the projection for 2021 is about where the S&P is right now. Remember, it's only up 2%. I just don't buy that at all. And here's why I don't buy it. If you guys have seen this chart, if you've been watching my show for a while, this is from Tom Boley at Earnings Beats, one of the best technicians in the world, in my opinion. It's a 12-year weekly chart, and you see how the S&P 500 moves in, basically fits and starts. It makes a move and it just cruises for a while. It makes a move, it cruises for a while, makes a move. And we're in this makes a move section. And I just think we've got some room to roll. I am not negative. I think if America can deal with what this political environment was, with the pandemic, with a recession, and still we're seeing lifetime highs literally today in the Dow and the NASDAQ, not the S&P and the Russell yet, but we're within a few half percentages of that. They're basically ignoring all of that and continuing to go higher. That is what secular bull markets do. So new bull markets historically build on the strongest first year gains. Now last year was the first year. Okay, now I know you heard me say that really it's just one long bull market from 2013. Okay, I understand that, but there's another way to look at it in that it was a bear market, and the launch out of that, which began on March 24th, because the low was March 23rd last year, for the S&P was fairly strong. We were really strong, as you guys know from last week. I'm not talking about last year's performance anymore, but 62.5% in one program, 63 in another, and even our ETF program was up about 22%. So we're probably not going to see that this year, but we still, if you see this average here, 2 years after, 24%, 40.6% on an average after 3 years or greater. It's really strong data. There's just nothing pointing to, especially with the government spending money. And if you think Trump spent money, imagine what it's going to be like under Joe Biden. So I mentioned earlier that there are some sources that are saying they think earnings per share is going to be weaker for the year. This source, I happen to believe a little bit more, is expecting a sharp rebound in earnings in 21 and 22. And that is, again, because I'm sure this has been revised from the fact that it's one-party government now. So the House, the Senate, and the presidency controlled by one party, by a razor-thin margin, by the way, but it still is controlled by one party. That usually means tons and tons of spending because the politicians want to curry the favor of their constituents, all right? I think that bodes well. So this is going to probably be, I think it's going to be the last time you see this slide, 2020 election. We will not be here next Monday night because it's a federal holiday, so my next show is a week from tonight. And as of that day, Joe Biden will be the president of the United States. Unless something really amazing happens. I mean, I don't know. And when I say amazing, I don't mean good or bad. I just, who knows? With this 2020 election year, anything could happen. But certainly he's slated to be sworn in on Wednesday, and we won't be talking about the 2020 election anymore. What amazes me is that traders seem to be totally unfazed by this second impeachment. Now, impeachment's a pretty big deal, right? At least it used to be. There haven't been that many of them. And no president until Donald Trump was impeached twice, this time without any witnesses, without any proceedings, without any debate. It just took 48 hours and it was done. I mean, it almost kind of makes you wonder if every single president going forward is going to be impeached. But even that there is a possibility that he could be convicted by the Senate and censured to the point where he could not run for office again, the markets don't seem to care. And that's the kind of behavior that you see from a secular bull market. I just keep like a broken record, guys. I'm sorry, but it's the truth. So how are voters looking toward the future? I didn't do a question on this, but I thought it might interest you to see this. As far as job loss, more Democrats worried about job loss, losing your job as a result of a looming recession. Again, more Democrats worried. International conflicts, more Democrats than Republicans worried. Not having the training to get a good paying job if your career changes, like for instance, leaving from airlines or hospitality and going into another area. Again, more blue voters than red voters. I thought that was an interesting data. Will that affect the markets? I don't know, but it is a component in people's mindsets. So the economic stimulus, most of us, at least we did, we got two $600 checks, and most of you probably did too. And of course, now there are many in Congress that say that needs to be a much higher amount. So there is bipartisan support, Republican and Democrat, for having another stimulus package. Why not just add another few $1 trillion to the debt, right? But I think it's going to happen. I think you're going to see 2,000 to 2,500. I don't know if it's going to be an addition or it'll just be tacked on over and above the 600 per person or 1,200 per couple. We'll see, but expect that money to be flowing. Again, just my editorial. I think it would be smarter to give it to the businesses to keep them from letting people go. I mean, I think it just makes more sense rather than giving it to individuals. Give it to the small businesses, which are 95% of American commerce, so that they can keep people employed. But if you take the money, you can't let anybody off. You can't let anybody go. And so that's my theory. We'll see what they do in Congress. Again, new administration, new Senate, new House. Entitlement spending. This chart goes straight up. Is anybody surprised? This is a percent of GDP. So we're going to be like between 13.5% and 14% of our total GDP is going to be spending on entitlements. This cannot be sustained. I'm sure that's not going to come as a surprise to you, but that's what I'm projecting, and that's what this chart is showing, that, yeah, we're heading towards just a crazy budget deficit. I wanted to put this in here because I think some people, and maybe most people, get concerned when it looks like our civil liberties are going to be threatened. Right now, we have one-party government, and big tech is not going to surprise any of you, whichever spectrum you are on the political scale. Big tech has decided that they are going to shut down Parler. They've obviously shut down the president. To me, it seems like regulating free speech. I'm sure people will find another way. There'll be new social media networks created. There are many that say that there's going to be a Trump media within, a month after he leaves office. I don't know the answer to any of those. I just know that when Americans are fearful of losing liberties, it affects their discretionary spending. And as a portfolio manager, managing money for many of you, that's a concern that I have. Obviously, as an American, I have many concerns from a liberty point of view and a freedom point of view. But since this is a financial show, that's what I have to watch on your behalf, is how this affects us financially. Charles Schwab and many others have decided we're not making any contributions, not allowing employees to make contributions through political action committees. I think that's a good step, frankly. I think if people want to support politics, it shouldn't be done through their business. It should be done personally. Whether they get a tax deduction or not, it's another story. But I think there's just enormous sums of money. I mean, there was $500 million that came into Georgia for those Senate runoffs. $500 million that had nothing to do with anybody living in Georgia. And I know we have a Georgia listener here and lives in Atlanta and knows the statistics. So I just don't think it's healthy for America. My 2 cents. I had this slide up here last week. Guys, do a screenshot on it if you got the software. These are the areas that you need to be thinking about now that Biden's going to become president. Higher taxes, more regulation, government-picked winners and government-picked losers. So I had one person say, that sounds biased. What do you mean by that? Well, the government's going to pick which industries. If an industry goes down, let's say that traditional automobiles really start lagging and can't keep up. For instance, Tesla is bigger than General Motors, Toyota, Volkswagen, Ford, AMC, Mercedes. They're a huge, huge entity. And if some of these more traditional automotive industries that are American go down, is the government going to be in a position to say, well, we're going to save you or not? This is what happened in 2008 and 2009. It's not really the proclivity of a conservative administration, more like a Republican, to make these choices. But I do think you see this in Democrat administrations. We'll see. Hastening of societal redistribution, that's just inevitable. Those are the entitlements that you saw about 7 slides back. No question that's going to rise. And more government spending. Honestly, any administration, left or right, is going to spend money because it pleases their constituents. And if they continue to do that, we're going to owe $100 trillion by the time I shuffle off this planet. And I don't know what the answer is for that, guys. It really concerns me. There's no question. This is the last time I'm going to put this up, but also do a screenshot on this so you can study it. It's worth it. It's a good compilation of data. The policy proposals on the left-hand side, the stocks that could be impacted. Obviously, a green is a good thing. Orange is, well, not really sure. And then red is, hey, that can't possibly be good. So, for instance, abolish private prisons, pardon me. Well, GEO is a private prison provider, so that's not going to help them. We'll be watching all of this. Obviously, during the Trump administration, he would make a comment about something to do in the pharmaceutical field, and we would have just bought something and it dropped 10% in a day. There'll probably be some times like that in this administration too. But hope you guys got that screenshot. That's where we're going to be studying and looking for investors and trying to investments and avoiding investments that could be minefields. Okay. Showing you this one last time. I know people are all concerned about, earlier Tom, said, are we still going to be okay with tech, with Biden coming in and everything's Democrat? Here's what's happened in the first few days. basically the first 4 or 5 weeks since the election. It's better this year than it was in 2016 after Trump was elected. I can't really explain that except to say we are in a secular bull market. And the markets just don't seem to care about politics. I think we care personally, all of us, more than the markets do. The market's looking at the charts and saying, this is going higher. We broke out of the 2013 congestion on April 10th, 2013, and this is going higher for probably at least a decade, if not longer. Okay? So what will be the economic aftermath after the inauguration? My Freudian slip. Portfolio will do better in 2021 than it did in 20. It'll do worse is answer B. It'll be unaffected in C, or really I don't know what to expect is D. Let me check the message board over here. All right. Guys, if you've got any questions for me before we finish up the show, just put them here in the chat. I'll stay here and answer them for you. Lively group tonight. As I said, again, reminding you there's no show on Monday because it's Martin Luther King Day. Mark, my portfolio will do better. Yeah, I think so. I hope so. I'll tell you what, if we keep doing what we're doing in SG, gosh, in the first 2 weeks, crazy. If the markets don't care about politics, then how are they intertwined? You know, that's a great question, Tommy. That's an outstanding question of the night. They're intertwined because on a short-term basis, there are knee-jerk reactions to policy changes. It's an outstanding question. You guys following this? They're intertwined on a short-term, almost reactionary basis, but over a long period of time, even 4 to 5 weeks, you saw very little change here. And I've shown you, I'm not showing you again this week because I showed you for like 3 weeks in a row. Go back and watch the last 2 episodes. But that chart that shows after 4 years of a Democrat administration, the markets are like 500 basis points higher than they are in the same time period with a Republican administration. Okay, so short term, politics definitely affect the market. Long term, not so much. Good question. Hope get control of COVID. I think it's going to be good, Doc, either way. And we will get control of COVID. Yeah, Andre, that was a good question from Tommy. So anybody else? Okay. Alrighty. So in summary, guys, I read this every end of program here, and it's from 2 Timothy, just one of my favorite verses here. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. It is my deeply held belief that we will not only survive this pandemic, this political climate, this election, and 2021 in general, we will emerge a stronger people, and I think we will have higher portfolios if we manage them well, if we stay the course and don't let the market scare us out of positions. Those of you that are clients, it's time to do annual reviews. If you have questions and you want to dialogue with me, I'm available. I'm in Chicago 4 to 5 times a year. Here in Nashville, we can do Skype calls, however you want to do it. You have any questions, any concerns at all, those of you that are not clients, look at what your portfolio's done. You've seen what our performance has been. If there's any way that I can help you or answer any questions, I get 4 to 5 a week now from people watching the show and from my appearances on stock charts. And I'm really happy to just engage and just give you advice, answer your questions, help you in any way that I can, okay? Let's see. I think so. I think we've got everything handled here, guys. This is Thursday, January 14th. I'm Charles Brown, Portfolio Manager with CB3 Financial. Really glad you guys were here with us tonight. We're going to put this political season behind us. We're going to move forward, and we're going to keep our chins up. We're going to be proud to be Americans. We're going to invest and make this country better, make this country great. How about that? Just really glad you're with us, guys. Stay with us. We'll be back next week. From COVID, U.S. politics, and the world economy to clarity. This is CB3 Live.
Thank you.